Thank you.
We're going to talk a little bit about international markets and what's driving those and the economy as well. This chart basically looks at most of the major markets, and some of them are broken out for individual countries, others are grouped for emerging markets. And as an investor, there's two things you're always going to be looking at. What is the dividend yield that you can get from that equity investment? And then what is the earnings yield? What is that company being able to produce in earnings? And what you can see is when you add those two up, certainly Russia is at the top there, but you take on a lot of risk if you want to invest in Russia. But at 22%. But what you also see is that when you stack them up versus the U.S., that at 7.1%, I think most of us are pretty happy. It's a reasonable yield in total for the U.S. It's slightly below its historical average. But when you look at the other markets, international is a very compelling argument from a dividend yield and evaluation perspective. So that's what we're looking at as we're making allocations and making long-term portfolio adjustments. It's certainly from a valuation perspective, from a dividend and earnings yield, international looks very attractive. This is the same slide that Ryan discussed, but it is for international. Actually, it's for Europe. And, same concept here, right? So we don't have the crystal ball to say exactly what's going to happen. But what we do for any of our investments as we make adjustments is we're monitoring how much risk are we taking on in the portfolios by having a particular allocation, and what are the odds of something happening, right? So as we look at it, there is in Europe the possibility of a slowdown. So this is what's called stagnation or recession, basic growth less than 0.5%. And the odds are 35%. But if you look at basically continued trend growth of 1.1%, or odds of acceleration in that growth at 29%, we're at 65% of being at where we are or better. And as we stand here, we look out for what Europe is going to be from an economic engine. We don't think it's going to be one of the strongest economic engines that exist in the world. But we do think that, given the current valuations and given some of the tailwinds that we'll be discussing, that the possibility for reasonable growth and decent upside in the market is very decent. So again, it doesn't mean that there's not any risk out there that, looking at some of these forward-looking indicators that Ryan had mentioned, that there's not some concern. So it does exist, but overall, the majority of our views looking at those indicators is positive for the markets. So Ryan mentioned how oil is a real positive for Europe. The declining euro is also very positive. So it peaked against a basket of indices, currencies in 2008. At 137, and then it really has been up and down, but steadily declining. Most recently, this January, down at 109. And what that does is when you start looking at these countries here, especially Germany, maybe Portugal, and Italy, and the fact that a lot of their GDP, this is the percentage of GDP, is exported. Germany really is the top exporter in the world, but a lot of the other Euro countries are very big exporters as well. That this is going to make their goods and services much less expensive as well. So as the stronger dollar being negative to us, this could be a real positive tailwind to Europe. The other piece that exists is all these lines here basically talk about yields for all these countries. And really all you want to be able to do is look at the general trend here. The general trend was in the recession from 2011, 2012, those yields spiked up, right? So the markets looked at Europe and said, I see a lot of risk there. I'm not going to lend the money unless I get a lot of money back. But in general, those yields have been declining. And even when you hear all these things going on with Greece and the new term Brexit, which is the Greece exit, that you don't see the crisis situation that existed back 2 or 3 years ago. Because as far as the financial sector is concerned, and the bonds that exist out there, there's not the risk that existed 2 or 3 years ago. And that's reflected in the yields. In many cases, for like Germany, the yield is only at 0.5%. So really declining yields. And what that means to these countries is the fiscal drag that existed before, so that's these gray bars in 2010 to 2013, was pretty dramatic, right? In Greece, the fiscal drag for those years was 14%. That means by having those higher yields, the government really had to shell a lot of money just to pay the yield on the bonds. Whereas now, we're looking at the purple bars, 2013 and 2016, it's still a drag, but much smaller, and that really is going to be also positive for those countries. The other piece, as you probably heard, is the European Central Bank, with Mario Draghi at the head, is going to try to follow the U.S. lead and do quantitative easing. So we went through QE1, 2, and 3. We went through the tapering of quantitative easing. And all that is where the central bank goes out and buys bonds. They're going to be buying $60 billion worth of bonds every month. They're going to be buying bonds from all different countries under the euro. And there's two things that it does. One is it does continue to push down rates. And so what happens is investors start saying, you know what, I'm going to take on more risk because having my euro just sit there in the bank gets me zero. And in fact, it actually declines in value if I consider any inflation. So it really incentivizes investors to take on risk. And then the other thing is there is an element that as the ECB's out there that the investors have confidence that the ECB is going to do everything they can to promote economic growth. And that's very important as investors. One quick point to make with this is basically looking at valuations of different countries. These are all emerging markets. And what you're looking at here is saying, okay, this is the average valuation from a global perspective. This is the valuation for each of those countries. This is the valuation for emerging markets. And what that's saying is this brown bar is the average for emerging markets. We're below average valuations for emerging markets. So again, it goes to this concept of, are we going to see growth in these markets? What's the rate of growth? And what's the valuation in those markets? And so emerging markets, we feel very comfortable that that's actually one of the economic growth engines for the global economy, and the valuations are below average. So as an investor, when that turns, we don't know, but that's a good time to be buying is when you have those elements in place. Another big piece with this is just looking at performance of these markets. IFA is the International Developed, Europe, Japan, and it's looking at it for 2014 and for the fourth quarter. And what it does is it breaks down and says, let's look at it in local dollars, so the local currency, and then let's look at US dollars. And what you'll see is, we'll look at Europe here. For 2014, if you own Europe and you owned it with US dollars, you lost 6%. If you own Europe and you own it in local dollars, euros, you're actually up 7%. So what this means is there's a real value to owning investments hedged with the dollar move. And in the portfolios for the last 6 months, we put in a European hedged position that has done quite well, even though year-to-date Europe's up, this hedge position is up even more dramatically because it's not getting the headwinds of the rising dollar. We also put in more conservative portfolios an international bond fund, both for diversification regarding interest rates, and that is also hedged as well. And that has done very well. So where we can, we add in some positions to hedge out the dollar, because as you can see, by doing that, you can actually have positive performance where you otherwise have negative performance. Moving on to fixed income.
Before we move on to fixed income, let me just kind of summarize. A lot of you may ask, why do we have 2 European funds in your portfolio, which we do. And the reason is, just as Marty just explained, one is in US dollars, one is in local currency. And last year that paid off to have that local currency because we made money. The valuations overseas we think are promising. We're still underweight overseas. We're looking at it carefully. We may add to some positions. Emerging markets look to be good, but we're very comfortable with the US stock market. And to round out oil, we know that a lot of news headlines have something to do with oil. I saw this YouTube over Thanksgiving. It's all about the based, all about the based. How many of you have seen that? It's still, I play it every once in a while because I love this song and I love that family doing this turkey thing. And if you haven't done it, look it up. Well, right now, the same song, we can just replace based with oil. It's all about oil. It's all about oil. It's all about oil. I woke up this morning to do our live interview at 6:15. I looked, oil, God, it was on a roll. It was up 20% in the last 3 days. And then today, to come here, I looked again at oil and it was down 10% today. So oil is one of those things that we're going to live with, as Ryan pointed out. We think oil will go up. We think that we hopefully touch bottom. If oil stays where it's at now, it's great for the consumer, but it also raises some concerns about the global economy. it's not so much supply and demand. Is there a conspiracy out there? Maybe. You know, we have countries like Russia and Iran that are really suffering because the price of oil is down so much. You also domestically, you have a lot of people that are against frackers. What better way to take our attention off alternative energy than to have low oil prices? So oil really plays into a lot. We bought into oil, and I will admit that. We have not panicked. We're going to stick with it. It's like catching a falling knife. When oil was $107 a barrel, we would not touch it. When it came down to about $60 a barrel, it looked nice. If I knew it was going to go down to 40, I would have waited. But we feel we will make money, hopefully sooner than later, in our energy picks. But that is one of the losers we have in the portfolio, and we're not looking to sell it because, if anything, we would add to it. But we're comfortable with our weighting of energy right now in the portfolios. And as I said, we haven't had it when it was high because we thought it was too expensive. Well, we loved it at 60, so we definitely love it. Right now, it's about $49 a barrel, so we're going to stick with it. So that's the story of oil.